Have you ever experienced that terrifying feeling of watching your account evaporate by thousands of dollars in literally just a few seconds when gold prices suddenly spiked? Or maybe you've entered a one-lot trade and just felt your heart racing because you had absolutely no idea how much money you were risking with every single tick of the price. Well, welcome to this explainer. I'm Edward, and today we're diving into the core mathematics of trading based on the Foil Trading Academy series. Because here's the harsh truth: 90% of new traders lose money, not because they can't predict where the market's going, but because they are completely blind to volume and risk calculation. If you don't want to become market prey, you've got to master this math. So we've broken this down into 6 logical building blocks. 1. The starting line. 2. The measuring tape. 3. Sizing up trades. 4. Calculating P&L. 5. Currency conversions. And finally, protecting capital. Let's kick things off with section 1, the starting line. Before we actually calculate anything, we really need to understand the exact environment we're operating in. The source material emphasizes that whether we're trading Forex, gold, or oil, we are dealing with CFDs. That stands for contracts for difference, meaning you're not actually buying physical bars of gold to shove in your garage. Right? Our primary focus is strictly on the exact price difference. From the moment we enter a trade to the moment we close it, every calculation from here on out is based entirely on that specific gap. Moving on to section 2, the measuring tape. So how do we actually measure that price gap? The source material uses a really brilliant real-world analogy here. Just like you would use meters and centimeters to measure a person's physical height, traders use pips and points to measure the exact distance of financial assets. Price has traveled. It's basically the universal language of market movement. And here is the absolute golden rule of distance. 1 pip is always equal to exactly 10 points. It's a fixed relationship. A point is simply a fraction of a pip, giving us that super precise micro measurement of price fluctuations. Let's look at how this actually shows up on your screen. For a standard currency pair, like the euro against the US dollar, the 5th decimal place is the point, and the 4th decimal is the pip. So if the euro moves from 1.08205 up to 1.08255, that's a 50-point move, which perfectly equals a 5 pip increase. Now Japanese yen pairs are slightly different. They shift this over to the 2nd decimal place. But recognizing these decimals is really your first step to tracking your money. Section 3, sizing up trades. Once you know how to measure distance, you kind of have to know how much weight you're carrying. Right. The source uses another great analogy. While kilograms measure human weight, lots are the standard unit used to measure the sheer volume of a trade in these markets. Think of a lot like a massive shipping crate. Choosing the wrong lot size is basically like driving a Formula 1 car but having absolutely no idea how sensitive the gas pedal is. Looking at the scale here, hitting the buy button for one standard, a lot of currencies, means you instantly control 100,000 contracts. But the market doesn't force you to play the big game right away. You can trade mini lots at 0.1 or micro lots at 0.01. For gold, one standard lot is 100 ounces. A micro lot 0.01 means you're trading a single ounce of gold, which honestly is the safest, smartest starting point to get used to the market's rhythm. And for oil, one lot represents 1,000 barrels. Just to show you the terrifying and thrilling power of volume, let's look at gold. If gold rises by just $10, say from 2,390 to 24, and you're holding one standard lot, you control 100 ounces. That $10 move instantly generates $1,000 profit. But obviously, if the price drops by $10, you lose $1,000 in the blink of an eye. This is exactly why gold is a magnet for quick wealth, but an absolute graveyard for those who don't understand risk. Section 4, calculating P&L. Okay, let's combine distance and volume using a classic Euro/USD trade from the text. Step 1. You buy one standard lot at 1.08205. Step 2. The price moves up to 1.08305. Looking at that 4th decimal, that is exactly a 10 pip increase. Step 3, we multiply our volume 100,000 contracts by that price difference of 0.0010. The math gives us a clean $100 profit. Beautifully simple, right? But what if your trade doesn't end in US dollars? Section 5. Currency conversions. This brings us to a really crucial step for cross pairs. If you trade the euro against the Japanese yen, your profit is paid out in yen, so Step 1. You sell a half lot and catch a 20 pip drop. Step 2. Your 50,000 contracts times that 0.20 price move equals 10,000, but that's 10,000 Japanese yen. Step 3. To figure out your US dollar profit, you just divide that 10,000 yen by the current USD/JPY exchange rate. Here, dividing by 153.80 gets you roughly $65. The exact same concept applies to the British pound against the Australian dollar. Step 1. You buy a quarter lot, and the price rises 20 pips. Step 2. 25,000 contracts times 0.002 gives you 50 Australian dollars. Step 3. Because of how this specific exchange rate works, you multiply that 50 AUD by the 0.65 exchange rate to lock in your final $32.50. It's an extra step for sure, but absolutely essential to know your true bottom line. Section 6. Protecting capital. We've talked a lot about calculating profits, but why is mastering this math truly essential? Because this exact formula, trading volume multiplied by pip movement, doesn't just calculate your wins, it dictates your absolute risk. The market doesn't care about your feelings. It strictly obeys this math. The source material makes this incredibly clear. Applying this exact math prevents heavy account blowouts. So many people trade based on pure intuition, throwing down half a lot just because they have a feeling it'll go up, but they have no idea that one unexpected piece of news from the Fed or a sudden geopolitical event can spike gold $20 or $30 and wipe them out in an instant. Calculating your pips, points, and lots removes the emotion it ensures. You know your exact monetary risk before you even place the order. It is literally your fortress. I love this quote directly from the PO Trading Academy series we're analyzing today. From there, we can manage profit and loss safely, avoiding situations of heavy losses where accounts cannot be recovered. That's the ultimate goal here, folks. It's not just about making money, it's about using calculation to shield your account so you can survive thousands of trades, not just get lucky on one. Which brings us to a final thought. Now that you have the formula to calculate every single pip and point, and you truly understand the immense weight of a lot, what are you going to do with it? Are you going to enter your next trade relying on a blind guess, or will you use the math to secure your survival? The numbers are right there. It's up to you to use them.